How do you find the net liquidation value of a company? Hey guys, how's it going? My name is Charlie Marr, and in today's video, well, this is actually going to be a multi-series video, so there's going to be multiple parts, but we're going to figure out how do you find the liquidation value of a company. But in particularly, how do you find the liquidation value of a company based off of Ben Graham's formula, which is NNWC. And it's called net nets. So NNWC stands for net working capital. Now, before we get into it, there's a couple things you need to understand. Number one, this is going to be different than when you have seen previously on my YouTube videos. What you've been seeing lately, it's very similar. It's the same foundation, but that I call it CMAR for Charlie Marr. It's just my own different way. I do things very differently and kind of evolve this. And I call that CMAR. But this video, it's going to focus exactly and particularly on the net working capital formula, like just that. So that's the first thing you need to understand. The second thing is there's going to be multiple videos. So in the first video, which is this one, we're going to go over the formula and some terms that you need to understand when you're going to dive into this world of looking for net stocks and the whole old Ben Graham method. In the second video, we're going to go over a live example and we're going to put the actual formulas to work. And that by that time, it'll make a lot more sense. In the third video, we'll go over some things to avoid. So how to avoid value traps and the type of stocks you should not be touching and messing with when you're doing this. Because believe it or not, there actually has to be the stocks have to have a set of criteria for it to actually even qualify and be able to work for net, or you'll be making huge mistakes and you can take heavy losses. On the fourth one, I may or may not release how to actually scan and screen for these and how to come across them, where to find them, the best websites, tools, the filters to use and all that kind of stuff. But anyways, so yeah, make sure to like and comment and share. I mean, it'll help me you'll motivate me to make part 2, part 3, and part 4 and release them all. So let's go ahead and get right into it. Let's talk about the actual terms and the formulas. Now, this might be very overwhelming at first. I'm not going to lie. It's going to be a little bit confusing and overwhelming, but I promise as you watch this video a second or third time, or as we go along and actually break it down in a live example, it'll make a lot of sense. So the first term that you need to understand is NCAV, which stands for net current asset value. So that is the first thing in this world that you need to understand. That is NCAV. Now, NCAV stands for net current assets. Asset value. If I could even remember how to spell value. So that's what NCAV, so whenever you hear about it, now you know, oh, it stands for net current asset value. Now, you might be asking yourself, well, what is net current asset value? Well, long story short, what Ben Graham back then did was he wanted to find the value of a company, but just based on its most liquid, or I guess you want to say tangible, liquid assets. So what you need to understand is when you're looking at a company's financials and you go into their financials, there are 3 statements that you're going to come across. You're going to come across the income statement, you're going to come across the balance sheet, and the cash flow statement. The main one we're going to focus on is the balance sheet. Now, inside the balance sheet, you're going to find a lot of items, and all those items are their assets. And so the first section of the balance sheet, you're going to see all the company's assets. In the second part, you're going to see all their debt and liabilities. And those two have to balance out, or you subtract them technically, not balance out. And that within the assets part, there's 2 sections, okay? And you need to know that a fun fact is that these are organized in order from most liquid to least liquid. So when you're at the very top, when you're inside the balance sheet, in the assets section, within the current assets section, all those current assets are the most liquid items. So you're going to find things like cash equivalents, short-term investments, their inventory, their account receivables, and that's practically all that you'll find in there. So Ben Graham was like, okay, if the company could pay off all their debt with just that section, with just their super liquid items, and there's money left over, then I, as a value investor, I mean, it's an undervalued stock. So that's pretty much where this is coming from. That's why this is where the current assets section comes from, because we're only focused on the current assets, which again is cash, short-term investments, cash equivalents, inventory, account receivables, which is money owed to them. Okay, so that is where this comes from. So if you just do this, that's where NCAV comes from, right? Now, once you get the NCAV number, you're going to come out with the, I don't want to say market cap, but it's like the market cap, but your valuation. So you're going to, let's just say you do the math and you come out with like, okay, it's around 10 million. The company should be around 10 million. Well, that is just the overall value of the company that you gave it based on the net current asset value. So the next one that you need to understand is NCAV PS. The PS is exactly the same thing. It's just per share. So it's net current asset value, but this one is per share. I'm not going to type it all in, but just understand that the PS at the very end stands for per share. And all this is you're going to divide the number that you come up with by its total outstanding shares. And now you get a number like, oh, this stock should be valued at $2 per share. Okay, so hopefully by now it's starting to kind of makes sense. You have your net current asset value. Once you divide by outstanding shares, you have your net current asset value per share. And that's the one that you that's the most popular one, because most people don't want to know, it's easier to look at, oh, I'm going to pay, the stock is trading at 50 cents per share when it should be at $2 per share, versus like looking at the whole company's valuation. So those are the two that you need to understand, right? The final one is the actual Ben Graham. Well, everything's under him, but the one that actually gives you the number that we want, or the whole reason we're making this video, which stands for NNWC. Now, NNWC stands for net working capital. Okay, so every time you hear people say, oh, it's a net stock, is this a net stock? Does anybody do net stocks? This is what they're talking about. They're talking about the net working capital. They're talking about this formula. Okay, so this is just the definition, right? So, what was I going to say? Net. Okay, so this is the NNWC. It equals the net working capital. So you might be asking yourself, well, what is the difference between this one and the other two that we just went over? Well, the difference is that this one is it's approaching it based on scrapping the company. It's based on discounting those current assets. Remember when we were talking about the current assets, which again, this will all make sense once we actually go into the company's like financials and you'll understand what I'm talking about. Well, with the NNWC, we're discounting these items and we're being very conservative, and we're looking at it based on a liquidation value, a scrap, type of approach. So that's the difference between the net current asset value and the net working capital. So what are the actual formulas for this, right? So now let's go ahead and go over the formulas. So the NCAV, which remember stands for net current asset value. This one's very simple. The formula is current assets minus total liabilities. So that is the formula for net current asset value. Okay, let me go ahead and kind of split this up here. Now, the net current asset value per share, which is, let's go back to the black one here. The net current asset value per share, remember this stands for per share, it's the exact same thing. So again, it's current assets minus total liabilities, but now we want the per share value, and the per share value, again, this is divided by the total I cannot spell outstanding shares. Okay, so that's the formula for these two. You got net current asset value, it's current assets minus total liabilities up here, and then you have net current asset value, which we divide by by total outstanding shares. So it'll give us a per share value. So now you might be asking yourself, well, what is the formula for the net working capital? Now this one's a little bit longer, so I'm actually going to write it kind of like from the top to the bottom, because it's going to be kind of long to kind of put it like long wise. But here is the formula for that. So this is the net working capital, and this is the one that you want to focus on. It's the one that we're going to be going over the live examples. It's the whole point of this video. So again, the formula for this is, I'm trying to think of how to write it. Okay, so it's cash and short-term investments plus 0.75 times account receivables. Let me close that out. Plus 0.5 of inventories. And then we're going to subtract the total liabilities. Okay, so this is the net working capital formula. It's cash and short-term investments. Now, within that, in the current assets, we're gonna discount account receivables, and account receivables is money that is owed to the company. Okay, but the problem with account receivables is that it's money that's owed to them, so we don't know if they're going to be getting that money. So we have to discount that. Inventory. I mean, I always give you the example: if you own a company that sells hats, and you have $100 million worth of hats, well, if you're liquidating your company, you're not going to sell the hats for their current value. You're going to discount them. You might sell everything 50% off. Like when a company goes out of business, everything's at a discount. So we want to know more or less what could we at least get if we sell everything at a discount. So for inventories, we subtract 50%. And then, so now that we have those items discounted, we're going to subtract all the debt, all the total liabilities. And that value left over is the net current asset value, the net working capital. And of course, it's kind of very similar going back to the first part. You have NNWC, and then you can do NNWC per share. So just to do the per share, all you have to do is once you have this whole number, you're going to divide by outstanding shares. By outstanding shares. So that's the formula. This is how you find the net of a stock. Now, of course, once you have this, you're going to come out with a number, right? So you're going to come out with, I don't know, let's just say a number 1. Let's just say the stock is 1. That's your net working capital per share, or the net value of the stock that you came out with. Well, now you need to add a margin of safety. So what Ben Graham did was he would actually multiply this by 0.6666 forever. So you can just do like 3 or 4 of them. And it's kind of like at third of the value. So you want to buy the stock if it's trading at third of a value that you came up with. And that's the margin of safety that he used. So to further this, so once you finish with this equation, which again, this might not make sense right now. It might be confusing, or maybe you understand it, but we'll go over a live example. Well, now you want to know if you should buy the stock. Well, again, if the stock is worth $1, you're not going to buy it for $1. You want to buy it at a margin of safety. That's when you multiply by 0.666. 6. Let's not slap at 3 6s. And so that would be the buy price. So to come out with the buy price, it's the net working capital value per share, but you're going to multiply that by 0.66666, so on. I usually do like 4 6s. You can do 2 6s. It's not really going to make a big difference. And then you'll come out with your buy price. And the stock is a buy if and only it's trading at or below the value that you get here. So guys, that is the end of this video. I just went over the formula of how to, well, first of all, we went over the terms that you need to familiarize yourself with, which is net current asset value per share, and the net working capital per share, and then how to come across the buy price. So that's the terms, that's where everything comes from, and that's the formulas. Now, in the next video, in part 2, let's actually do this For real, let's do this on an actual company. So I will see you guys on the next video. Make sure to like and subscribe so I can go ahead and keep releasing the other parts. And yeah, let me know what you guys think so far. I'll see you guys on the next one.